Hey everyone, this is Navjot here, realtor and partner with Affinity Real Estate. With me, I have my business partner and realtor, Connor Graham. He is also very good in economics. I will ask him why he's so good at economics. So tell me about it.
Bit of a overstatement potentially that I'm fantastic at economics, but I do have a background working in insurance and financials. So either way, I do have a different lens that I can look at.
Okay, that's good. So, a lot of people ask us where our market is going. So, we have seen with whenever interest rate goes up, our real estate market goes down by few percentage.
Sure.
What do you think? Is that the real reason, the interest rates?
Yeah, so I think it's a two-part question. So the impact of the interest rates on the economy, obviously across the board, it's going to affect everything from your purchasing power, whether you're buying groceries or real estate. The biggest thing that I could say to most people watching this who wouldn't already know this, to say it's the only reason is an overstretch. If you calculate how much the market has been impacted by interest rates, it doesn't equal to the same amount that we've seen the market come down.
Yes, and but still, what we have seen, people always compare real estate with the stock market.
Yep.
So, is it a real good comparison? What do you think?
I would say absolutely not. So the stock market, obviously, the potential, the target is to create more wealth by investing in something.
Yeah.
Now, real estate, obviously, most people who are buying real estate are purchasing it for a place for their family to live. Typically, in a normal market, you should see that real estate's going to increase in value by around the same amount as inflation and population growth, which are very close percentage changes year over year.
Mm-hmm.
Over the last few years, we've obviously seen very rapid growth,
Okay.
which does point to the conversation around interest rates. So when you compare it to the stock market, the one major difference that I can point out is liquidity. So liquidity is how quickly you can get rid of an asset.
Okay.
So in the stock market, there's more people who are willing to purchase, say, an Apple share.
Okay.
When it comes to real estate, though, it's only one person who can buy that house.
Yes.
We've been in a situation over the last few years that there's a lot of people competing for the same house, but that's by no means normal.
Okay.
It used to be normal, as an example, to say, I'm listing my house. And for a while, sellers got comfortable saying, I'm selling my house, because it was a given.
Yep.
So the only thing that's really changed in this scenario is that homes have become very liquid,
Mm-hmm.
in the sense that you could sell them somewhat quickly,
Yes.
with say a 30 to 60 day closing,
Mhm.
but that doesn't mean it's normal. So as we continue heading back towards a more balanced market, and I don't think we're currently in a balanced market, it's still a seller's market. Even though prices are trending downwards, it's still a seller's market because you're not listing a home for 6 months
Yes.
and wondering if you're going to sell it.
Absolutely.
Yeah.
But the another thing is we always talk about the emotional reason behind the buying and selling homes, which is not the sole investment purpose.
Mhm.
And you did put some light on that. So one thing I will say, because we see the population growth of certain areas a lot, and the way the work from home is rising in last few months, and I will say since COVID, it has become a more trend. The people in IT industry, they are living in this kind of environment since last almost a decade,
Mhm.
because IT industry offers. The thing is, other industries like insurances and call centers, they started offering that thing too. So, is it helping the real estate, or it's going against it?
I would say at the end of the day, it's just changing real estate, and it's
Yeah.
changing the way that cities work. It's changing the ways that small towns work. One example I could give you is during COVID, you had a lot of people moving to more rural areas because if they didn't have to drive to work 2 hours every day,
Yeah.
it wasn't a problem to move 2 hours from where you work. Now, as people get called back to the office, I do think that there's going to be a trend away from people working in offices.
Mhm.
However, things can't happen overnight like they did with COVID.
Yes.
A lot of small businesses especially could not afford to house or to allow employees to work from home.
Mhm.
So those employees still stayed at the office.
Okay.
However, I do think it's going to become more frequent that people are working from home, and with that, changes that reflect that in the economy and the real estate market are going to are going to be more apparent?
So I think it is actually helping our real estate market, especially like our GTA and Southwest Ontario, because before real estate was centric to Toronto only, or nearby cities like Mississauga, Peel, like the Peel region, the Toronto region, Durham region. But now, when people started moving out, there was so much difference between the price of Toronto versus
Absolutely,
price of
yeah.
Mississauga Beach. It's a really good example. Like nobody was willing to buy there for $100,000.
Yeah.
Now people are spending $1 million over there.
Yeah,
So
absolutely.
that there is a spread of the house prices. It's not centralized
Correct.
to a downtown.
Yes.
So, but another question before we end up today's session is inflation and recession. I didn't know that they are different till we had that conversation before.
Sure, yeah.
I was illiterate in that, but now I know inflation is different than recession. So right now we know our inflation is 6.8%. So should we say we are in recession, or it's just inflation?
So by definition, a recession is when you have 2 consecutive quarters, so half of a year, with slowed economic growth, essentially, to simplify it in the easiest of terms. So if we're seeing that the economy is slow for half of a year straight, without recovering in between, typically they'll look at indicators like, for example, the stock market. If you're seeing losses for that long, that's an indication that we're in a recession. Really, a recession is just a bell that the government can ring to illustrate where we are at with the economy.
Okay, and how about the inflation?
So inflation, it's typically calculated. Obviously, the inflation that you feel as a consumer is different, but typically it's calculated with something called CPI, Consumer Price Index, and they will take what's called a basket of goods. So they pick household perishable items, typically, so groceries and all that kind of stuff, and they'll calculate how much the cost of this has gone up. Now, one important factor, especially related to this question, that we as realtors need to take into account is the fact that, for example, mortgage payment isn't taken into account. So when they calculate it, they have not even considered the fact that most mortgages are going up too, with the rising interest rates.
Yeah.
So arguably, when they say inflation is up X percentage, it doesn't actually look at the full picture. So it's also important to wear the hat of a realtor and understand that if home prices are up along with everything else, that it's going to have impacts above and beyond, the stated amount of inflation.
All right, so that's good. I think for this particular session, that's enough information for viewers to analyze. And if they have any question, they can always reach out to us. There will be phone numbers, website, and our link tree in the description of this video. Thank you so much for watching. Have a wonderful day.